Advisors are balancing liquidity in their accounts when considering private market investments, by typically taking into account the total allocation to private markets within their portfolio. So we're seeing a lot of semi-liquid alt stuff, not surprisingly, make its way into the platform. Our recommendation is typically no more than about 20% in the portfolio. Obviously, there's a lot of education involved as well. So home offices educating their advisors, advisors educating their clients and saying, this is semi-liquid, but it's still very illiquid. And if you anticipate needing this cash at any time in the near term, probably don't go this route, because even though, it might be an interval fund with quarterly liquidity, you're typically capped on how much you can redeem at any given point in time. So it's very important upfront to have conversations with your end clients about the goal of that part of your portfolio. And make sure you don't get into something you can't get out of when you need to. So I would say the biggest factor limiting adoption would be technology. At this point, I think the product structures are there. There's enough product out there, although it's continuing to grow every day, for wealth advisors to access liquid alts and private markets in particular. But the biggest impediment is definitely technology. How do you fit these investments into a portfolio? And then if you're using a firm like Envestnet to trade that portfolio, how does Envestnet trade around that position? A big part of our platform is rebalancing and trading. And so we need to make sure that we're getting accurate information from the fund companies on trading windows, and we could stage trades appropriately. And manage that liquidity aspect of it. We are building in some features on the platform to limit the total allocation to these products. And then subdocs. How do we process subdocs on the platform? Interval funds are great. They're mutual fund. They trade like mutual funds for the most part, absent, the daily liquidity, if you will. But once you start getting into tender offer funds, non-traded REITs, BDCs, et cetera, you're looking at subdocs. How do we integrate that subdoc process into our typical proposal process and account opening process and make it as seamless as possible for advisors is really something we're going to try to solve for in the next year or so. So semi-liquid alts within the traditional investment framework, you hear a lot of stuff, obviously, about the 60-40 portfolios now, the 50-30-20. And I think, it's not just marketing. I think we tend to agree with that from an asset allocation perspective as well. 20% of your portfolio, I think, is okay to allocate to illiquid investments, assuming you have a long-term investment horizon. And we see a lot more interest, I think, right now in the private credit space of semi-liquid alts because of the interval fund structure that they're available in. So obviously you take a little bit of your traditional public fixed income exposure and would allocate that to private credit. But there is, if you look at the returns on private credit, typically these funds are promising somewhere around 8 to 12%. So those are equity-like returns. So you could also consider carving a little bit away from your equity allocation. For private credit, private equity, I think we all know, I think is definitely going to come from your traditional public market allocation, but we would say anywhere between, depending on if you're a moderate to growth kind of oriented client, 10 to 15% into private equity. And then there's sub strategies as well, right? Like, is it a buyout strategy? Is it a growth equity strategy? Are they investing in secondaries? I think you'll read a lot of stuff about secondaries are a good first step into private credit because of the diversification they provide and a little bit more stable returns, if you will.